Hi everyone, I'm Sherry Bechtel, editor for Finder's Investing Channel, and I'm here to break down what ETFs are and how you can invest in them. Let's dive in. You may have heard the acronym ETF thrown around while researching your investment options. But what are ETFs exactly? ETF stands for Exchange Traded Fund. This is a type of investment fund that holds multiple securities such as stocks, bonds, currencies, and commodities like gold and silver. Each ETF has its own ticker symbol, and you can trade its shares on a stock exchange like you would any individual stock. The main difference between ETF shares and individual company shares is that with an ETF, you hold a basket of multiple companies instead of one individual company. You'll find many types of ETFs based on the securities they hold, their leverage, or the way the funds are managed. The four most common types are index ETFs, which hold the same stocks or securities in the same proportion as the index they follow. For example, an ETF that tracks the S&P 500 or the Russell 1000 index would move the same way as the index would. Index ETFs are often known as passive ETFs. Leveraged ETFs are similar to index funds, with the main difference being leverage. For instance, if an index moves 100 points in a trading day, a 3 times leveraged ETF that tracks the index would move 3 times more, or 300 points in this case. Inverse ETFs move in the opposite direction of the index or securities they follow. For example, an inverse S&P 500 ETF would rise when the S&P 500 index would fall, and vice versa. Inverse ETFs can also be leveraged. Thematic ETFs hold stocks in a particular industry or a social trend. This can be an ETF focused on artificial intelligence stocks, 3D printing, robotics, technology, climate change, and the like. Now that you know what ETFs are, let's talk about some of their advantages. For starters, a single ETF can include hundreds and even thousands of stocks. By investing in a single ETF, your portfolio is automatically diversified among all of its holdings. ETFs also give you trading flexibility, meaning you can buy or sell any fund whenever you want. What's more, you can buy as many ETF shares as you want, even on margin. Another ETF benefit is the low cost. Say you want to buy all stocks in the S&P 500 index. You would pay the transaction cost of each stock you buy. When you buy an ETF that follows the index, you hold the value of all of its stocks with a single transaction. Now that you know the benefits of investing in ETFs, let's shift gears and talk about some of the drawbacks. Every ETF has something called an expense ratio. This is the annual fee you pay to own the fund. The expense ratio is often between 0.03% and 4% of your invested funds. This means you'll pay anywhere from 30 cents to $40 each year for every $1,000 you invest. Luckily, most popular ETFs charge less than 1% annually. Thinking of investing in ETFs? Most online brokerages make it easy. First, you'll need to do your research and find a brokerage that works for you. If you need help comparing brokers, check out our guide. It's linked in the description box below. When you've found the right broker for you, open and fund your account. Keep in mind, it may take a few days for your funds to clear. Next, you'll want to research the ETFs your broker offers. You can search for them by name or ticker symbol in most cases. Finally, you can decide how much you want to invest and buy shares, just like you would an individual stock. To wrap up, ETFs let you own multiple stocks or other securities with a single transaction. This makes them a great way to diversify your portfolio and avoid the risks of owning individual stocks. For more info on ETFs, check out our beginner's guide. It's linked in the description box. And if you like this video, don't forget to subscribe and hit that notification bell so you'll never miss a new Finder video. Thanks for watching.